Well, hello everyone. This is Ken Winans and Stephanie Larson, and we're hoping that you are trying to enjoy the summer weather a bit. And even though we're obviously know that it's been a very, very interesting time in world economics, certainly there's news coming out every day, good and bad, but generally, things that we have to synthesize and filter through. But we wanted to give you a very quick talk. As many of you know, if you've gone on your portal, or you will be receiving them shortly. The mid-year reports went out on your portfolios. And, generally speaking, bear markets are rough on all of us. I mean, it happens for stocks 22% of the time and for bonds about 17% of the time. So it is a fact of life when it comes to investing. But I am generally happy to report that the defensive strategies that Stephanie and I have put in place throughout much of this year have worked to keep losses minimized. And to certainly, just to, weather the storm as best as we possibly can. And I know that you all know that Stephanie and I have been at work here every day. The entire staff is back in office every day, with all hands on deck, so to speak, as we go through things. Before Stephanie jumps in on bonds, let me just...
I was going to say, I also talked a lot about this in the quarterly write-up. Mm-hmm. So I would recommend if you haven't read it, I would give that a read. It has a lot of really good information in there.
Yeah, absolutely. Just real quick, I mean, the age-old question of what, by raising cash in the portfolios and putting hedges in place, what's the end game? It's very simple. When we get into a logical point to re-enter the market, and remember that I still think we have a bear market that's going to go on for a while, or at least we're going to have a sideways going stock market as the inflation is still part of the economic picture. But within that, there will come a point in time, more than likely it will be the fall, we will lift the hedges. We will plan to commit a large part of the cash in companies that are doing well in that environment. I've been really surprised as I'm adding new names to stocks we're buying. It has been a very long time since I've added names like Coca-Cola, Johnson & Johnson, Alcoa. These are company names that I remember as a junior analyst back in the 80s that people bought. They just weren't what growth managers were buying. But keep in mind, the objective is to buy into a dip, and at that point to try to make back a good part of the money that has been lost. We have proven very successful in doing this in 2009, certainly in 2003. Many of you who were with me back then remember, just as we were going in and invading Iraq, we were buying stocks, and it worked out very well. So we're very in tune with what has to be done and how we have to, the game plan going forward. And Stephanie and I talk about it all the time. But Steph, you want to talk about your world in the bonds?
Yeah, so 2022 has been really interesting, to say the least. So the bonds have pulled back quite a bit. I know that normally bonds are boring and steady. They diversify your portfolio, they mitigate risk, they balance, and they provide a steady stream of income. Well, as Ken mentioned, there is historically a lot of price fluctuation. We're in one of those times right now. The Fed raising rates has really put a lot of pressure on the market. It's oversold, in my opinion. They kind of baked the cake a little bit too much. Everything kind of went out with the bathwater, for every pun intended. So what's happened is that a lot of the bond prices have softened, and you have to remember, during COVID, the prices were extremely high. It was actually hard for me to buy bonds last year. Everything was kind of at a premium. A lot of our bonds were trading at 105, 110. So even just coming down to the 90s, that's still a 15%, 10, 15, 20% swing, right, in prices, even if they're not dramatically low. But there are some bonds that I feel are being unfairly picked on. And I think I mentioned this in the last video. Dish Network was one that we just bought. It was trading in the low 70s. I bought Pitney Bowes in the 80s. It's kind of nonsensical. And the nice thing is it's a huge buying opportunity, which I spent the previous few weeks before quarter end buying every bargain bond I could possibly find. I bought a couple of dozens. So if your account needs a bond, I'm buying for you. If you have cash, I'm buying for you. And we're locking in 9, 10, 12, 15% yield to maturities, which I think is just insane. So although it's not fun to watch the prices go down, the opportunity it's created has been very good. And I would argue that if you have any money on the sidelines right now, especially considering what inflation is, putting it to work, even though it might feel counterintuitive or it might feel scary or it might feel like it's the wrong time, it's not. When a window like this opens, they don't open for very long and they don't stay opened for very long. And you have to be really aggressive because the prices for bonds V, and they V very hard. And they do it consistently, more consistently than equities. And they'll also lead the equities. So if Ken is right, and we're playing the seasonality game, and we think the fall, the equity market's gonna really pick up, if bond prices lead, then they're gonna go first. So we have to, again, maneuver this window. We had a small window like this open up in March of 2020 with the flash crash. This has been a longer window. It's definitely been this full year. As I mentioned in the quarterly commentary, and Ken mentioned in his last Forbes article, the only time that the bond market has been down this much in back-to-back quarters, this one, 2022, is ranked number 3. The other two were the 1980 bond crash and the Great Depression. Those are the only 2 back-to-back quarters that have been this bad. I mean, that just kind of goes to show how oversold it is. But when you're looking at your quarterly report, look at the bond section. Look at your par amount, the value of the whole portfolio, the face value of the portfolio of bonds, and then the market value. And you'll see there's going to be sometimes a 10 or 15% difference. You're going to get the full value back of your bonds if we just wait and hold them. It will come back. So I know it's hard. A lot of times our bond clients, our income investors tend to be retired. So I know this can be an exceedingly scary time. But if you want to talk about it, shoot me a note, and we can get some time on the calendar for us to go over your quarterly report. You can either reach out to Amy or myself, and we can find some time to discuss this. So I know it's hard, but I promise the only thing that will make this better is time, and you just have to give it a little bit of time. And I actually forecast that the bond prices will recover probably about 5% between now and the end of the year, maybe a little bit more. Everything that I'm reading, that's kind of the indication. We're at least on the bond side, I'm seeing things firm up. So I do think things will get better. Just give it a little time. Okay?
Just keep in mind, I've been through this many, many times, and you do have people who will look at doing tax loss selling going into the fall. So again, we expect volatility will continue. When I look at some of the stocks that have been badly mauled, unfortunately, everybody else has seen them as well.
Yeah.
And then you couple that with, we know some people who took some big hits in Bitcoin. It's been a rough year across the board for a lot of people. So I do think there will be some tax losses being harvested going into the fall. That's again why we're waiting through the summer. We're doing selected buying here and there where things are on a case-by-case basis. But no, I would just parrot what Steph just said. If you have money sitting around, like Lord Rothschild said back in the 1800s, when there's blood in the streets, buy. And there is plenty right now. And I think that would make sense to go after things in the fall. We know how to play this game well. We move forward. Let me just also say very quickly, and again, we have to change our thinking. Inflation, we're having an election cycle, as we all know. It's going to get nasty, as we all know. That's going to add fuel to this fire. There's just a lot of things that are going to continually hit the markets with very volatile swings day in and day out. But the thing we're looking at very closely right now is earnings. Earnings are going to be reported over the next 2 weeks. Well, actually for the next month, because a lot of companies have delayed the reporting.
The bulk of ours are in the next 2 weeks.
Yeah, in the next 2 weeks. So you will notice that there will be some companies that we will sell. You might be shocked at who those names are, but my attitude is I'm rather agnostic right now. I don't care who the CEO is. I don't care how famous they are. If the stocks are hitting new lows, I'm tempted to get rid of them because that tells me that a lot of people with tax loss selling will be selling them as well. So we're really drawing a line in the sand going forward with continually individual stocks hitting new lows, and we're just going to let the cash build up. I would also say this, let's talk briefly about commodities. Commodities did have a pullback. They went up too far too fast, but as it is with inflation, inflation doesn't go straight up. If you go back and study what happened in the 1970s or even after post-World War II, it pulsates. It goes up, it pulls back, it goes up and it pulls back, and it has those ebbs and flows. And interest rates will do the same thing, and the markets will as well. But I'm really modeling our, as much as you can, this situation. I'm modeling it on the late 70s, early 80s, where you had stagflation. You can make money. Commodities play a dominant play, but commodities will do the same thing. They're going to go up, they'll pull back. They'll be profiting, they'll pull back. We'll do the same thing. We will buy the dips. You might have recently noticed we did take profits in a lot of commodities because they simply violated the parameters that we had for the uptrend. We're still targeting them on a day-to-day basis. We will look at rebuying them later on. There's also a seasonality to commodities based on harvest seasons. So we have that going on. So we know we've thrown a lot at you. Stephanie, anything else you want to add? Or?
Yeah, I think sometimes a lot of people maybe don't understand our portfolio management process. And I think that might be a specific video that we do in the future, because I think it would help kind of educate people about how we kind of do things and why you see things in your portfolios and don't. I think one of the good things to mention, I've gotten a couple emails about this already, about people asking us if we're going to start buying cheap securities, cheap stocks. Specifically the NASDAQ names, the tech names have gotten really picked on, right? I think Netflix is down like 70% at one point year to date. I mean, something ridiculous. Amazon, Apple, Apple's had a couple good days, and I hear the talking heads on the TV and they're just like, oh, maybe Apple's having a run. And I'm like, that's 3 days of not sucking is not a run. That's just you not being the worst.
That's a dead cat bounce.
It's terrible.
Yeah.
So I think understanding about what we're looking for and how we follow trend matters. Just because, let's pick on Netflix, for example. Say Netflix has just gotten mauled this year for various reasons. Leadership change, it could be fundamentals, it could be raising costs, it could be lack of viewership or viewership's gone down. Whatever it is, you can talk about a company agnostically and just understand the fundamentals that are going with it. But what we see on the stock side couples with that and adds flavor and color. What I see is a stock that's just dying, and I don't want to bet, that I don't want to guess a bottom. I don't want to say, oh, it's really cheap now, because just because it's down as much as it is right now doesn't mean that's the bottom. So you have to see a stock have a little life in it before you're like, okay, maybe it is actually done and it's oversold and the fundamentals still look good and the multiples look better, and fill in the blank of whatever that happens to be, where we'll go, at the very minimum, it's going to be on our watch list now. Maybe we'll buy it. Another really good example, and actually I have this in my portfolio because I'm a glutton for punishment. I have Peloton in mind. I bought it at like 15. Now it's, I think, 9 or something. And it has gone down, is the biggest fall from grace I've ever seen on a stock in a long time. And it just sank like a stone. And I bought it. I bought a couple shares. Why? Because I still like Peloton. I still think it will do good in the long run. I'm willing to hold it, and even though it's not doing anything, and it is still going down, and it's just bumping down the road, and it just looks like garbage. But this is one of those ones I'm just gonna buy a few shares of it and just sit in it because I can, right? Do I think it'll go back up to 175? Probably not, but I can buy it at $15 and wait and watch. But that's the difference of the philosophies, is we're looking for really specific things to tell us that A, it's oversold, B, it's ready to buy, and C, the trends have changed. And that's the part that we're waiting for. So if you are gonna send me an email like, hey, have you been looking at this? It's really cheap. I promise we see it, but it doesn't fit our thematic approach. And trust me, when you wanna have managers that have a consistent thematic approach to the portfolios, we're not just willy-nilly going after the next biggest idea. There's a reason why we didn't get into Bitcoin. There's a reason why we didn't do certain things. And although I appreciate ideas that clients send us, but it won't fit the way that we manage the money. And you don't want us to veer off the reservation, if that makes sense. Yeah. So anyways, I think that would actually be a really good video for us to really explain how we approach at least the equity side.
Well, and of course, our methodology is also on our website.
Yeah.
Two other quick things. I've been asked questions about preferred stocks. We have the same feeling about preferreds that we have about bonds. There will be opportunities there, and the tax preferential treatment of the dividends is still very compelling, but we are going to wait on that as well. Again, you have to be very careful because preferreds act more like long-term bonds when you have a Fed rate cycle. So I really am looking at how preferreds will act as the Fed continues to raise rates, and there will come a point in time where it will already be baked into the cake and people will start buying those.
Speaking of the Fed, I know they're going to do about another 175 basis points this year. At least that's the projection. I think 75 is probably on the next meeting list. So there is going to be some more action. The question is going to be how much of it is baked into the cake already, and how much is it going to keep spooking the market. So we'll see.
Very, as they say, data dependent. Hey, one final thing before we go. For many of you, when you did our survey, I guess it was about 4 months ago, you asked about wealth management and financial planning, which are the key areas that we, one is an investment manager. Our job is to actually manage the investments themselves, but there's a lot of other functions of finance and financial services that people need more than they have from us or your accountant. So I want to let you know that we're opening a new company called Winans Wealth Management. It will be in conjunction with Access Wealth Management, who's one of the companies that we work with down in Southern California. But anyway, if you're interested in financial planning and wealth management, contact Amy. We will begin the process of getting you involved in that. Again, we're still managing the portfolio. You're not turning that over to anybody, but on anything else you need, like a financial plan, estate planning, generation skipping, trust, insurance, any of those kind of things. You don't turn to me for those things or Stephanie. We have other people you can work with on that. So just want to let you know, we've listened to what you've asked for. We're bringing it to the table. And if there's anything else you need, just, again, feel free to talk to Amy, and then we'll set it up for you.
And then I was going to quickly mention, I know that the merger with Schwab and TD is quickly approaching us, fastly approaching us. We want to get ahead of the curve so a couple things. One is that if you are a TD client and you're fine going to Schwab, I personally would recommend that we start that process now. It just might be easier for us to do the account transfer, and then you're not gobbled up in all of the back office problems that I know is going to happen. Because I know for a fact, talking to some TD people, that they have already let go a lot of the back office, and they're preparing for this, and they're consolidating, and it's going to just be a dumpster fire. It is. So if you want to get ahead of the curve, I strenuously recommend it. Secondly, we have been evaluating custodians for a year now. We've talked at length with Fidelity, Pershing, Interactive Brokers, Axos. Am I missing anyone?
No, that's about it for now. Yeah,
it's about for now. So they're all big names. If you don't know Pershing, Pershing is Bank of New York. So everyone should be familiar with that. We haven't made a decision on what our prime backup's going to be. We are working with Interactive Brokers. They're going to work on our CTA side, so anything that does futures or options or anything like that, because they're one of the few custodians that will do it. But what we have learned is that their trading system and their onboarding for their clients is not great, and we don't want to have that be your experience too. So Interactive Brokers, although we have a relationship with them, won't be our primary backup. So we're still evaluating. Really, it's going to be between Pershing and Axos at this time. Fidelity is pretty much a no. So we'll let you know when that happens. So if you're with TD or even if you're with Schwab and you're just dissatisfied with them, we will present our primary backup custodian once we've agreed upon it. If you want to move, that's great. If you're at TD, you're forced to move and you don't want to move to Schwab, then we'll give you an option. But we're still working on that. It takes a long time to kick the tires with the custodian. So. And
just also remember, it has no effect on how we manage your portfolio. It has no effect on your ability to look at our electronic portal that hopefully most of you are now using to evaluate your portfolios. So the dependency on the custodian is really much more from our side, administratively and also fiduciarily speaking. It's more on our side than it is yours. I mean, I don't know about you folks. It's been a long time since I've walked into a Schwab or a TD office. Pretty much everything's done online now. So where that used to be very important a decade ago, it's just not anymore. Yeah. So Pershing, for instance, doesn't have brokerage offices. You don't, you do with everything online, but like Steph said, They've been around for a very long time. They're owned by a bank. They did not need a bailout in 2008. That's my one rule. I don't like to work with custodians that needed to be put on life support by the federal government back in 2008. That's why I've always worked with Schwab and TD. That's why a lot of the other firms, including a lot of them that were my former employers, I just don't think leopards change their spots. If you get in trouble once, you'll probably do it again.
Yeah.
And so I just don't want to be dependent on that situation. So anyway, we've talked a lot. We've thrown a lot at you. So we both had a lot of coffee today. So forgive us for being a little amped up on a Friday. Tea. Yeah, her and her tea. So anyway, look, we hope to see you soon enough. I'm trying to get back on the road again, but we both agreed when the markets are acting like this, we try to stay in the office. I try to not be out that much because we need to really have our eyes on the game here. So anyway, folks, you take care of yourself, enjoy the rest of your summer, and we'll talk to you again soon.
All right. Bye, guys.
Bye.